Silver strong, silver stronger than gold. I mean, China's pulling its silver off the market. LBMA is leasing silver. Turkey's silver imports are spiking again. I think I'll share what I think. China is really smart. And throughout the last 30 years, anytime they got out of line by manipulating their currency, they were called on it by the US, which used the UN or used the IMF or used the World Bank as its proxy. And China immediately would back off and say, we're not manipulating currency. We're not manipulating currency. China is a honest player publicly. What they're doing in private is a completely different story. And the reason that gold and silver, especially gold, but now moving into silver, are so important is because the US and the G7 do not consider them money. And because they're not considered a global currency in the FX market, you can't manipulate them.
Across the global monetary system, a quiet but decisive contest is unfolding, and gold and silver have become the preferred tools for nations seeking to reconfigure the balance of power. Vince Lanci's analysis reveals a structural realignment that goes far beyond price action or market cycles. It exposes how countries that have spent decades constrained by the Western financial order are increasingly turning to physical metal as the one instrument Washington cannot sanction, dominate, or control. The behavior of China, Turkey, and key emerging economies illustrates this shift with remarkable clarity. Their strategy is not built around speculative positioning, but around removing metal from the Western system, tightening available supply, and using physical settlement as a shield against the political leverage embedded in the dollar-based architecture. When a commodity is treated as currency by the East and dismissed as irrelevant by the West, the market becomes the battlefield, and the flows tell the real story. Lanci underscores that silver is already showing signs of asserting itself as the more aggressive instrument in this geopolitical contest. China's discreet but persistent off-market accumulation, Turkey's accelerating imports, and the LBMA's growing reliance on leased metal all indicate a market where physical availability is thinning far faster than price action suggests. This divergence between paper signals and physical demand is not accidental. It represents the opening stages of a new monetary playbook in which nations sidestep traditional FX pressures by accumulating the one asset category that the G7 cannot categorize as manipulation. The fact that these metals are not recognized as currencies in the Western system ironically grants other countries full freedom to use them without diplomatic consequence. In effect, the West's refusal to treat gold and silver as money has removed the regulatory chains for everyone else. Investors watching these flows recognize that this is not a temporary dislocation, but a structural evolution. Gold's remonetization in the East is no longer theoretical. It is happening in plain sight. And Lanci argues that silver is now quietly following the same path. The global commodity status that once weakened precious metals within Western monetary doctrine is the very feature that now makes them unpoliceable vehicles of settlement, reserves, and strategic accumulation. As the United States and its allies continue relying on financial pressure and dollar leverage, other countries are opting for assets that lie outside that domain entirely. When physical metal becomes the diplomatic firewall of choice, price charts only capture a fraction of the underlying story. To understand how this shift is manifesting inside the market structure itself, from sovereign accumulation patterns to COMEX distortions and the emerging currency bypass systems, you need to follow the data that Lanci lays out in his main analysis. Before we dive deeper, make sure you're subscribed, hit the like button, and turn on notifications. This channel breaks down metals, macro, and monetary strategy with the clarity mainstream finance never provides. We appreciate the support and hope you enjoy the video.
Main story. Deutsche Bank says sovereigns are no longer buying gold based on price, but on predetermined ounce targets, signaling a major structural shift in global monetary behavior. Governments are effectively printing whichever currency is needed to secure metal, creating persistent inelastic demand. That's the key phrase, inelastic demand, that lifts the floor under gold. Deutsche Bank argues reserve managers will keep accumulating through dips, while jewelry and ETF flows play a secondary role, even though the ETF flows themselves are now seemingly somewhat inelastic. If this trend holds, gold's rise is far from over. We would also add that this vindicates something that we observed a year ago when we were doing some analysis on India's gold demand. And we noticed that since 2022, India's demand had been the same amount of ounces per year, regardless of the price. They're buying ounces. They're not budgeting money. And that story is titled Sovereigns Print Fiat to Buy Gold Now. And you can find that in premium. We have a bunch of other stories. We want to just touch on them to let you know that it has been a busy weekend starting Friday for the metals as well as for us. First, something on COMEX is really rotten. This is our analysis. A surge in massive unexplained revisions to COMEX gold open interest is raising red flags with us about hidden losses, market stress, and the integrity of America's key gold benchmark. Rich Dad Kiyosaki sells his Bitcoin despite assurances he would not do that. After vowing he'd, quote, never sell, end quote, Rich Dad author Robert Kiyosaki, dumped over $2 million worth of Bitcoin and shifted the money into real-world cash flow businesses. For the founders, one of the posts we sent to the founders was a breaking story and something we'll share with premium as soon as we develop it a little bit more. But basically, Europe and India just agreed to bypass the US dollar in cross-border payments by linking their instant settlement systems, marking a major step towards regional reserve currencies with a special mini-pod broadcast. If you're wondering what that is conceptually, when you go to the bank and you want to transfer money, forgetting Venmo and PayPal and all those other things, and even Zelle, when you do a drop down, it says, do you want to do a wire? Do you want to do an ACH debit? Well, now it's going to be, do you want to do what we have, which avoids SWIFT altogether? And that'll be something that retail will use first, and then institutionally will be mandated from the top down as people get acclimated to it. Next, UBS raises gold to a 4,500 to 4,900 for 26-27. UBS just lifted its gold forecast to as high as $4,900, calling the metal the strongest global asset and a critical hedge as geopolitical and fiscal risks mount. Hartnett, Bitcoin is the tell for 2026 Fed policy. Bank of America's Michael Hartnett says Bitcoin is the tell for 2026, arguing its slide is the first clear signal that liquidity is tightening and the Fed will soon be forced to cut. We would add Michael Howell at Capital Wars has been talking about the liquidity issue and the liquidity cycle and Bitcoin's relationship to it for a reasonable amount of time. And it certainly makes a lot of sense. It goes to the concept of Bitcoin is a tech, behaves more like a tech stock than a store of value. At least, at the margins it does. When the liquidity cycle turns, Bitcoin gets hit first. And stocks got hit first as well, but stocks have bounced magically, but they've bounced. Again, for the founders, how the market keeps us honest. A veteran CIO explains why the old line, more buyers than sellers, is real wisdom, not sarcasm, and why markets often move hardest long before the reason becomes visible. Why is the market up today? More buyers than sellers is the old joke, and people think that that's sarcasm. It's really not. It's we don't know why. We'll find out after the fact, because in a sense, traders not in the know are mushrooms kept in the dark and fed a lot of shit, and we find out after the fact. Next, a couple more stories, I think. Italy's gold tax, pay now and pay later. Italy is moving to tax and track private gold holdings, unveiling a voluntary amnesty that could transform centuries of family wealth into a fully monitored state asset. That's no bueno, or no bono, if you're Italian. That's authoritarian government. Finally, gold and metals producers anchor MSCI's latest China edition. China's major stock index is being reshaped by a surge of gold and metals producers with, if I can say this right, Zijin Mining leading a wave of new additions that signal Beijing's growing tilt toward hard asset power and dictating important assets from that part of the world. Russia expands gold operations as domestic liquidity rises. That's our news and explanation of why it's not bearish for gold.
Lanci points to a major turning point flagged by Deutsche Bank. Sovereigns are no longer buying gold based on price, but based on fixed ounce targets regardless of market conditions. This shift to inelastic demand fundamentally changes how floors form beneath the gold market. Governments are effectively printing the local currency they need to accumulate metal, eliminating the typical sensitivity to price fluctuations and removing the elasticity that once dictated market behavior. India's multi-year pattern of acquiring the same volume of gold annually, whether the metal was cheap or expensive, served as an early indicator of this transition. When sovereign reserves prioritize tonnage, dips cease to be opportunities for panicked selling. They become automatic accumulation windows driven by policy, not emotion. At the same time, Lanci highlights deep structural concerns emerging from COMEX, where massive unexplained revisions to gold, open interest, suggest hidden losses and potential stress beneath the surface of the U.S. benchmark system. The pricing apparatus that once framed global perception is showing signs of instability at the very moment sovereign demand is detaching from traditional market behavior. Layer onto this the rapid development of dollar bypass payment linkages, such as the new Europe-India Instant Settlement Bridge, which signals a broader trend toward regional reserve currencies and alternative corridors outside the SWIFT framework. Coupled with UBS raising its long-term gold target toward the $4,500 to $4,900 range and major strategists warning that liquidity conditions are shifting faster than equity markets suggest, the landscape is becoming increasingly incompatible with the assumptions that have anchored Western monetary dominance for decades.
So starting with gold, we are in the wedge. The old adage was if you're trading gold, you're trading wedges, meaning there's always lower highs and higher lows, and the market hits a wedge and breaks out of it down in the old days. But now it might be breaking up. I wouldn't call this a wedge yet, although it certainly is a wedge, but I think we're going to have a lot more of that. We'll see what happens on the other side of it. That's the 30 and 50-day moving averages. The 40-day does seem to be governing this. Hat tip to CEO Technician. Let's pull up our lines, the lines that we drew going back and the new ones, and see how that fits. Remember, we contend it's a trading range now, just like the one that started in April. It's not 4 months long yet, but you won't have the benefit of that until it's in hindsight. We're just saying the chances grow that it is sideways channel. And there's our lines, right? Okay, so just to recap, this is the support that matters, 39.14, and this is the resistance that matters, 41.68. And in that area, we're going to trade a range. We're going to extend it outside. This was important to us before. This was if the BIS or someone large put a cap on this rally, as is their responsibility when the market gets crazy, and then the market stopped here and dropped, well, that's an echo. Could be the same player, could be someone else, doesn't matter. And so that defined the range from here to here, from here to here. And I did say when we get above this line really shouldn't matter and we should go to here, and we did. But I got bullish-er because we got above this. And of course, it reversed and went down. But we're in a range. It's not a big deal. And I'll tell you what's very encouraging. What's very encouraging is that this line, which shouldn't matter, I think I did this like 6 months ago. This line, which shouldn't matter, seems to matter. I say that because usually when a market overextends to the upside of a range, it will overextend to the downside. I think it's extremely encouraging that the market did not go back down to this area and retest it in short order. Implicitly, the floor is being raised again. So here's your range from 39.16 to 41.59, give or take, right? When the market gets overbought, it needs to work off being overbought, and that means it might go down all the way to 39.16 or so again. However, it is stopping or at least pausing in this area here. That's encouraging. That says to me, whoever the buyer was down here may in fact be buying up here now. And that buyer may be a bullion bank, it may be a new buyer, maybe Chinese order flow. It could be anyone because we have a real dynamic market now. So if we do get below here, I think you're going to see some buying in this area here, and this might be front running of that buying. That's it. So we're in a range. Don't get too excited because it is buy season. You want to be bullish, but we just had a tremendous bullish sell season. So be happy where we are. Silver, judging from my lines, it's above lines that matter. So maybe I should be thinking about it the way I think about gold and pop a line in there that looks like this. Now, I didn't see this before. I should have, though. So you could say we're in this range now, and if we break it, we can go all the way. I'm going to move this up now. I'm going to raise the floor myself. Okay. And I'll leave that there. And that's it. That's our range. We're in the middle of it. Silver strong. Silver stronger than gold. I mean, China's pulling its silver off the market. LBMA is leasing silver. Turkey's silver imports are spiking again. I'll share what I think. China is really smart. And throughout the last 30 years, anytime they got out of line by manipulating their currency, they were called on it by the US, which used the UN or used the IMF or used the World Bank as its proxy. And China immediately would back off and say, we're not manipulating currency. We're not manipulating currency. China is a honest player publicly. What they're doing in private is a completely different story. And the reason that gold and silver, especially gold, but now moving into silver, are so important is because the US and the G7 do not consider them money. And because they're not considered a global currency in the FX market, you can't manipulate them. It's a global commodity. And so China and Turkey and India and anyone can do whatever they want, and the US cannot accuse them of manipulation because it's not fiat. It's not a government controlled asset. It's a global asset. And the thing that has weakened gold for almost half a century, the fact that it's just a commodity, it's not a currency, is now ironically the thing that is undermining the West's ownership of it. Can't manipulate a commodity if it's globally traded, can you? Well, that's what's happening now. And now, as gold is being remonetized in the East and silver is going to follow suit in the West, we're still struggling with it's just a commodity, and that will be our demise.
Lanci then transitions to the technical structure, where gold continues to trade within a well-defined range. The market's inability to revisit the lower band despite repeated overbought conditions suggests that the floor is quietly rising. This behavior is consistent with the type of underlying sovereign demand he described earlier: participants who accumulate not for speculative timing, but for reserve stability. The 30, 40, and 50-day moving averages reinforce the presence of a governing structure beneath price, one that reflects disciplined buying rather than opportunistic trading. Gold's sideways consolidation may appear uneventful, but the lack of downside follow-through is itself a signal that a larger structural change is underway. Silver presents an even more compelling configuration. Price has pulled above the lines that define Lanci's critical zone, and the recalibrated floor suggests that silver is positioning itself for a range that could open the door to a much broader advance if the upper boundary breaks. The underlying flows tell the story more powerfully than any chart. China quietly withdrawing metal from Western channels, LBMA requiring significant leased supply to maintain stability, and Turkey continuing to import at levels normally associated with crisis hedging or reserve rebalancing. These behaviors are not random. They represent a coordinated shift toward metals as strategic assets rather than portfolio components. As gold is remonetized in the East, silver is beginning the process that gold underwent nearly a decade earlier: slow, structural, and largely invisible to those still viewing it through a commodity-only lens. The most important takeaway from Lanci's perspective is the growing disconnect between rhetoric in the West and real activity in the East. For over half a century, gold and silver have been dismissed as commodities irrelevant to modern finance. That dismissal is now the vulnerability other nations are exploiting. A globally traded commodity cannot be accused of currency manipulation, cannot be frozen by sanctions, and cannot be weaponized by policy intervention. In a world where geopolitical pressure is increasingly executed through the banking system, metal becomes the countermeasure. This is the environment shaping the next decade for precious metals investors, and understanding these structural forces is far more important than chasing short-term volatility. If you found this breakdown useful, hit the like button, subscribe, and share this video with anyone following the geopolitical transition in real assets. Your engagement helps this channel continue delivering the detailed, data-driven analysis that investors rely on. Thanks for watching, and see you in the next one.